All right, everyone, today we're exploring the world of derivatives, focusing on the essential instruments known as forward commitments and contingent claims. Derivatives are financial instruments that derive their value from an underlying asset, like a stock, bond, commodity, or even a market index. They can be powerful tools for managing risk and securing future transactions. Let's break down these categories, starting with forward commitments. Forward commitments, as the name suggests, involve firm and binding agreements. In this type of derivative, both parties agree today to complete a transaction at a future date on set terms. Think of it as a promise. No matter what happens in the market, both parties are obligated to fulfill this contract. These include instruments such as forwards, futures, and swaps, each with specific features tailored to particular market needs. In simpler terms, a forward commitment is like reserving a hotel room at a fixed price. Whether the rates go up or down, the price you agreed on holds firm. The linear payoff structure means that any gain or loss is directly related to changes in the price of the underlying asset. Now, forward commitments can be either exchange traded or over the counter, OTC. Exchange traded contracts, like futures, are standardized and managed through a central clearinghouse, which reduces counterparty risk. OTC contracts, on the other hand, like forward contracts, are private agreements between parties, offering flexibility but with higher default risk. Let's say an airline company anticipates fuel price increases. They might enter an OTC forward contract to lock in a current fuel price, thereby controlling costs. Although more customizable, they risk the supplier not honoring the contract if financial trouble arises. Before we move forward, guys, want to download these PDFs? You're in luck. They're all neatly organized by topic area right here on this page. Just make your purchase, click download, and you're set for quick, efficient CFA prep. The link is also in the description below. Forward contracts are personalized agreements where two parties agree to buy or sell an asset at a predetermined price at a future date. Unlike futures, these are not standardized and are settled only on the contract expiration date. This specificity suits businesses looking for unique terms, but introduces default risk due to the lack of a central clearing entity. In a forward contract, two parties agree today to buy or sell an asset at a fixed price on a future date. Say a coffee producer and a coffee buyer agree to trade 10,000 pounds of coffee in 6 months at $2 per pound. The coffee producer, who fears prices might drop, has a short position in the forward, guaranteeing they'll get $2 per pound. The coffee buyer, expecting prices might rise, takes a long position, locking in their purchase price. Because forward contracts are private, customized agreements, they're traded over the counter, OTC, meaning they aren't standardized and can be tailored to specific needs. This flexibility makes forwards ideal for hedging, especially when dealing with unique or specialized assets. However, because there's no exchange to back them up, forward contracts carry counterparty risk, the chance that one party won't follow through, which is a big consideration for both parties. Let's consider another simple example to grasp this concept. If an agricultural business expects the price of corn to rise, they might enter a forward contract to buy corn at today's price. By locking in the price, they hedge against future price increases, protecting their profit margins. But since this is OTC, they carry the risk that the other party may not fulfill their end of the deal if market conditions shift. Futures contracts, by contrast, are standardized agreements to buy or sell an asset at a future date, traded on organized exchanges. They differ from forwards because they involve daily settlement, known as marking to market, which manages default risk by requiring gains and losses to be settled daily. Picture a scenario involving gold. An investor in a futures contract for gold benefits from the security of knowing that the exchange's clearinghouse will handle all trades, ensuring contract fulfillment. Every day, any market price changes adjust the contract's value, and the investor's margin account is credited or debited accordingly. This daily marking-to-market mechanism limits loss exposure by keeping each party's balance at zero after each trading day. In futures trading, both parties are required to deposit an initial margin with the clearinghouse, which acts as a safety net against daily fluctuations. Should the account fall below the maintenance margin due to losses, a margin call occurs, requiring additional funds to bring the balance back up. Imagine an investor who holds a gold futures contract that initially required a $3,000 margin. If market prices dip and their margin falls below the required maintenance level, they'll need to top up their account to avoid position liquidation. This margin system is one way futures differ significantly from forward contracts, where money exchanges hands only at contract expiration. All right, let's talk about one of the key aspects of managing futures contracts: understanding how margin calls work and the price levels that might trigger them. Imagine you're holding a long position in a futures contract. Here, the margin account acts as a safety net, ensuring you have enough funds to cover potential losses. But what happens when prices start to swing unfavorably? That's where knowing the margin call trigger price comes into play. For a long position, a margin call occurs if the price drops by a certain amount. Specifically, this amount is the difference between the initial margin requirement and the maintenance margin requirement. So if prices dip below that level, you'll receive a margin call requiring you to deposit additional funds. This is known as the variation margin. Failing to meet this call on time means your broker might liquidate your position to prevent further losses. This same concept applies to short positions, but in reverse. An increase in price is what would trigger a margin call in this case. The variation margin is that extra cushion, the amount needed to bring your account balance back up to the initial margin level when prices move against you. Think of it as the difference between keeping your position active and risking liquidation. This practice helps maintain the account balance and limits potential losses for both parties involved. Exchanges often set daily price limits to prevent excessive volatility and speculative trading frenzies. These limits are defined as the maximum allowable change, either up or down, from the previous day's settlement price. So if the price limit for a gold contract is set at $5, trading won't occur beyond a $5 increase or decrease relative to the previous day's price. Why set these limits? They serve as a market safeguard, protecting against dramatic losses and helping maintain order. And if the price limit is breached, exchanges may activate circuit breakers to temporarily halt trading. This provides a cooling off period for the market to reset. Now, let's say you hold a futures position, but decide you want to exit early. Futures allow for flexibility, and you can offset your position by taking an opposite contract with any counterparty. Since the clearinghouse acts as an intermediary, it simplifies the process, allowing you to close out your position before the contract expires. Imagine an investor who's long on oil futures but expects a price decline. Rather than wait for expiration, they can take a short position on the same contract to offset their original position, thereby locking in profits or minimizing losses. Open interest is the total number of outstanding contracts in the market at any given time. It's a helpful metric for understanding market sentiment. Rising open interest can indicate a trend continuation, while declining open interest might signal that the trend is losing steam. It's a bit like watching traffic flow. The busier it is, the more active the market. Finally, futures contracts come to an end through either physical delivery or cash settlement. The exchange specifies which applies. Physical delivery means the actual commodity is exchanged, while cash settlement is simply the difference between the contract price and the current market price paid to the relevant party. Let's bring this to life with an example. Say an investor takes a long position on one gold futures contract with a contract size of 100 ounces and an initial price of $500. They start with a $3,000 initial margin and a $2,000 maintenance margin. Now the price fluctuates over a few days. Let's say on day one, the price falls to $494, causing a $600 loss. The account balance dips to $2,400 above the maintenance margin, so no margin call occurs. On day two, the price rises slightly to $495, adding $100 to the balance, bringing it to $2,500. Still no margin call needed. On day three, the price drops sharply to $488, resulting in a $700 loss. This brings the account balance down to $1,800, triggering a margin call since it's below the $2,000 maintenance margin. To continue holding the position, the investor must deposit an additional $1,200 to bring the balance back to the initial margin. For a short position, the pattern would be opposite, gaining from price drops and losing when prices rise. Understanding these triggers and managing margin requirements are essential for avoiding liquidations and maintaining control over your positions. Let's move on to swaps, which are essentially a series of forward contracts arranged to exchange cash flows over time. Swaps come in various forms, but the most common type is the interest rate swap. Imagine company A has a floating rate loan and expects interest rates to rise. They might swap their variable interest payments with company B's fixed payments. In this swap, company A is now paying a fixed rate and receiving a floating rate from company B. This arrangement helps company A stabilize their interest payments while company B benefits from the floating rate exposure. There are other types of swaps like currency swaps where two parties exchange principal and interest payments in different currencies, and commodity swaps, often used by companies in the energy sector to lock in prices for raw materials. Swaps are incredibly flexible and customizable, which is why they're typically traded over the counter. Large corporations and financial institutions use swaps extensively to manage risk and improve cash flow stability. So let me repeat this. Swaps are firm contracts where two parties agree to exchange a series of cash flows over time, often to manage exposure to interest rates or currencies. They're akin to a strip of forward contracts, but provide greater flexibility by letting the parties define cash flow specifics. To understand how swaps work, first recognize that they are customized derivative contracts allowing two parties to exchange future cash flows, typically one fixed rate payment for one floating rate payment. Although they function much like a series of forward contracts and can even be viewed as a portfolio of forwards, Swaps typically begin with zero value, meaning neither party pays anything up front. The notional principle, a critical concept in swaps, serves solely as a basis for calculating interest payments but is rarely exchanged. Instead, the parties settle by exchanging the net difference between the fixed and floating amounts, which helps reduce credit risk. In a standard arrangement, the floating rate payer receives fixed payments, while the fixed rate payer receives floating payments. This setup is particularly useful for managing interest rate risk. For instance, a company with a floating rate loan might use a swap to convert it into a fixed rate obligation and vice versa. When focusing on a plain vanilla interest rate swap, one side pays the fixed rate and the other pays the floating rate. Over time, only the party that owes more will make a net payment to the other. These simple mechanics make plain vanilla swaps one of the most commonly used tools for hedging interest rate exposures. Swaps have become essential tools in managing long-term financial exposures for companies and financial institutions alike. Now, contingent claims work differently from forward commitments. These derivatives, like options and credit derivatives, only come into play if specific events occur. The holder of a contingent claim has the right but not the obligation to execute the contract. This non-linear payoff structure results in an asymmetric payoff pattern, often requiring a premium payment upfront. Now, let's talk about options, one of the most flexible and popular derivatives. An option gives the buyer the right, but not the obligation to buy in a call option or sell in a put option, an asset at a fixed price, called the strike price, before or on a specified expiration date. This optionality is what makes options powerful. They allow you to wait and see how the market behaves. For instance, if you own a call option to buy a stock at $100 and the stock price rises to $120, you can exercise your option and buy it at the cheaper $100, netting a $20 profit per share. But if the stock price stays below $100, you can let the option expire, losing only the premium you paid upfront. Options are among the most familiar contingent claims, and they come in two primary forms, calls and puts. A call option gives the holder the right to buy, while a put option grants the right to sell an asset at a pre-agreed price. However, exercising these rights only makes sense when market conditions make it profitable, which is why options can expire unused. Consider a tech investor who buys a call option on a promising stock. If the stock price rises above the agreed upon exercise price, they can call it, profiting from the difference. If the price drops, they simply let the option expire, losing only the premium paid. This limited downside, unlimited upside characteristic makes options popular for hedging. Options are also available in different styles. European options can only be exercised at expiration, while American options can be exercised any time up to expiration. This flexibility, especially with American options, makes them ideal for managing risk or speculating with limited downside. Options can also form complex trading strategies like straddles and strangles to profit from specific market conditions without owning the underlying asset. All right, let's dive into understanding how an option's value works before and at maturity. This boils down to intrinsic value, the actual in-the-moment value of an option. Now, for call options, we calculate this intrinsic value by looking at the maximum of 0 or ST minus X. In simple terms, if the current stock price, which we'll call ST, is higher than the strike price, X, then the call option has value. Why? Because it gives you the option to buy the asset below its current market price. For put options, the intrinsic value is the maximum of 0 or X minus ST. Here, a put has value when the market price drops below the strike price, since it allows the option holder to sell above the market price. Next, let's figure out when an option is in the money, out of the money, or at the money. If an option is in the money, ITM, it means it has positive intrinsic value, which is a good thing for the holder. For a call option, this happens when ST, the current price, is greater than X, the strike price. With a put option, it's in the money if ST is less than X. On the other hand, if the option is out of the money, OTM, it has no intrinsic value. A call is out of the money when ST is less than X, while a put is OTM when ST is greater than X. Then there's at the money, ATM, which is exactly as it sounds, when ST is equal to X. An at the money option has no intrinsic value at expiration, so we consider it OTM since it's not profitable to exercise it. Let's talk about payoffs for call options at maturity. At expiration, the value of a call option is either 0 or the amount by which the current price exceeds the strike price, whichever is greater. We write this as maximum of 0 or ST minus X. So if the final stock price, ST, is above the strike price, the call expires in the money, and the payoff is ST minus X. If ST is below X, the call expires out of the money, and it's worth 0. When ST equals X, the call is technically at the money, but since the payoff is 0, we still consider it out of the money at expiration. Now, the profit for the call buyer is maximum of 0 or ST minus X minus C0, which is the option's payoff minus the premium paid, C0. For the seller, it's the reverse, negative maximum of 0 or ST minus X plus the premium paid. The seller's profit is limited to the premium received, but they owe the buyer if the call expires in the money, which can mean substantial losses if the underlying price rises high enough. Now let's look at the payoff of a put option at expiration. For a European put option, the value at maturity is either 0 or the amount by which the strike price exceeds the spot price, or in math terms, maximum of 0 or X minus ST. If ST is less than X, the put is in the money, and the payoff is X minus ST. If ST is above X, the put expires out of the money, and its value is 0. When ST equals X, the put is at the money. But since there's no value in exercising it, it's considered out of the money. The put buyer's profit is maximum of 0 or X minus ST minus P0, where P0 is the premium paid. For the seller, it's negative maximum of 0 or X minus ST plus P0. The seller benefits from the premium, but will have to compensate the buyer if the put ends in the money, especially if the underlying price has dropped significantly. Here's a quick recap. For the call buyer, the payoff at expiration is maximum of 0 or ST minus X, while for the call seller, it's negative maximum of 0 or ST minus X. For the put buyer, the payoff is maximum of 0 or X minus ST, while for the put seller, it's negative maximum of 0 or X minus ST. A few more key points to remember about options, payoffs, and profits. The maximum profit an option seller can make is simply the option premium they receive upfront. For the option holder, the maximum loss is also limited to the premium they paid. They can't lose more than their initial investment. However, the maximum loss for a call option seller is theoretically unlimited because there's no ceiling on how high the underlying asset's price can rise. For the call holder, potential gain is also unlimited, mirroring the price's rise. For put options, since the underlying price can't fall below zero, both the maximum gain for a put holder and the maximum loss for a put seller are limited by the asset's lowest value. All right, let's talk about credit derivatives, which might sound like one of those dry financial terms, but trust me, it's anything but. Think of credit derivatives as a kind of financial safety net. They're contracts where one party pays for protection against bad things happening, like a company defaulting on its loans, while the other party gets paid to take on that risk. In simpler terms, it's like insuring your house, but instead of fire or floods, you're insuring against things like bankruptcy or missed payments. What makes credit derivatives so versatile is that they can be linked to various underlying assets. These could be the debt of a single company, a group of issuers, a bond index, or even a portfolio of loans. This flexibility allows financial institutions to manage their risk without necessarily selling off their investments. But how does this all play out? Let's dig a little deeper by looking at the most popular credit derivative, the credit default swap, CDS. The CDS is the rock star of the credit derivatives world. It's like the Swiss Army knife of credit risk management. Here's how it works. The protection buyer, usually a bank, fund, or investor, pays regular premiums to the protection seller, who acts like an insurer. If nothing bad happens, the seller keeps the premiums and everyone goes about their business. But if a specified event, like a default or bankruptcy, occurs, the seller has to step in and compensate the buyer. Let's make this real. Imagine a bank holds corporate bonds issued by XYZ corporations. The bank is nervous about XYZ's financial health, but doesn't want to sell the bonds because they're paying a good yield. So the bank buys a CDS from another financial institution. Now, if XYZ defaults, the CDS seller compensates the bank for its losses. It's a win-win. The bank gets protection, and the seller earns regular income, unless, of course, the worst happens. Now, who does what in a CDS? The roles in a CDS are pretty straightforward, but incredibly important. On one side, you've got the protection buyer, who uses the CDS to hedge against credit risk. They pay regular amounts, kind of like paying an insurance premium. The idea is to protect themselves if the underlying company or asset hits trouble. On the other side, there's the protection seller, who collects those premiums in exchange for taking on the risk of default. If nothing happens, the seller pockets the money and moves on. But if a credit event occurs, they're on the hook to pay the buyer. Let's say you're the protection buyer. You've invested in corporate bonds and you're worried the issuer might default. By buying a CDS, you ensure that if the worst happens, you'll be compensated. Now, flip the script. As the protection seller, you're betting that the company will stay strong. You happily collect the premiums and hope you won't have to pay out. It's all about managing risk and reward. Now here's where things get even more interesting. The value of a CDS isn't static. It changes based on the credit quality of the underlying entity. If the credit quality deteriorates, the market gets nervous and CDS spreads widen. For the protection buyer, this is good news because the value of their CDS increases. They locked in a lower spread earlier, and now the cost of buying similar protection is higher. On the flip side, the protection seller isn't thrilled. They're stuck with the risk while the market is demanding more to take it on. On the other hand, if the credit quality improves, the spreads narrow. Now, the protection buyer isn't as excited because their CDS is worth less. They're paying more than the market rate for similar protection. Meanwhile, the seller is in a better position. They locked in a higher spread earlier, and the risk of having to pay out has decreased. Let's make this real with an example. Imagine you bought a CDS on XYZ Corp. when the market wasn't too worried about defaults, so you paid a low premium. Later, XYZ's financials start looking shaky, and everyone's scrambling to buy protection, pushing the spreads higher. Your CDS becomes more valuable because you locked in that lower rate. But if XYZ gets its act together and spreads tighten, the value of your CDS drops. It's less of a hot commodity. So why does all of this matter? Credit derivatives, particularly CDS, are incredibly practical tools in the financial world. Take a pension fund, for example. They've invested in a bunch of corporate bonds, but start hearing whispers about instability in the energy sector. Instead of selling the bonds, potentially at a loss, they can buy a CDS to hedge their risk. If the sector collapses and companies start defaulting, the payout from the CDS offsets their losses. On the other hand, imagine a hedge fund sees an opportunity. They believe the market is overreacting to those whispers about the energy sector. By selling CDS protection, they collect regular premiums, confident that defaults won't happen. If they're right, they walk away with the income. If they're wrong, well, that's the risk they took on. At the end of the day, credit derivatives are more than just financial contracts. They're tools that let institutions manage credit risk without having to sell or restructure their investments. For protection buyers, it's about hedging against potential losses. For sellers, it's about taking calculated risks for steady income. And for the financial markets as a whole, these instruments help spread risk and improve liquidity. Before we move forward, guys, let me give you a quick tip. If you're serious about nailing the CFA exam, these PDFs you see on screen are pure gold. They break down the tough stuff, make revision feel like a breeze. They've been a favorite among CFA candidates for years. So just download and start using them to streamline your studying and boost your retention. Grab yours, see the difference, and thank me later. You'll be glad you did. The link is in the description. All right, now we are towards the final section of our lecture. Let's talk about firm commitments and contingent claims. When we say a derivative is a firm commitment, we mean both parties in the contract are legally bound to fulfill their obligations. There's no backing out here. If you've agreed to buy or sell an asset, you have to follow through no matter what happens with the price. This commitment applies to instruments like forwards, futures, and swaps, where there's a set agreement and both sides must deliver. On the other hand, contingent claims are a bit more flexible. With contingent claims, the obligation to exercise depends on the price of the underlying asset relative to a set price, called the exercise price or strike price. Options are classic examples of contingent claims. Here, you only exercise the option if it makes financial sense. Like if the market price of a stock is higher than the strike price in a call option, you'll exercise to buy the stock at a discount. Now, let's look at some similarities between a long forward, a long call, and a short put position. These positions share something important. They all benefit when the underlying asset's price rises. Imagine you're holding a long call option. You've got the right to buy an asset at a fixed price, so if the price goes up, your option gains value. It's similar for a short put option where you're selling the right to sell. If the asset's price rises, your risk as the seller drops, making your position more profitable. A long forward position is in the same boat. When you're long in a forward contract, you're committed to buying at a set price in the future, so you want the asset's price to increase. All three positions benefit from an upward movement in the underlying. Let's take an example. Suppose we set the exercise price X equal to the forward price, F sub T. Now, in this setup, a long forward position is like holding a long position in the underlying itself. You're locked into buying it at a future date, hoping the price will rise by then. It's similar to a long call option because you're set to gain from the rise in price, but with some downside protection in exchange for paying a premium. It's also comparable to a short put option where you give up the potential profits from price appreciation in return for a premium. Here, your exposure to losses is limited, but you're not positioned to gain as directly from a price hike as in a long forward or long call. All right, folks, let's dig into a really cool concept, the equivalence of profits between a forward position and profits from call and put options. This idea helps you see how different derivative strategies can actually end up giving you similar results. Let's talk about something seriously cool in finance, how a long forward contract can look a whole lot like a combination of two options. If you've ever been mystified by the way traders swap between forwards and options, this little insight is about to lift the veil. When you enter a long forward contract, you're agreeing to buy some underlying asset, let's say a stock, a commodity, or something else, at a set forward price on a future date. If the asset's market price at maturity ends up higher than your agreed upon forward price, you come out ahead. If it's lower, you lose out because you're stuck buying at that higher price. Now, let's bring options into the mix. A long call option, with its strike price set to the same number as the forward price, gives you the right but not the obligation to buy the asset at that strike. If the market ends up above that strike, you can buy at the lower strike price and instantly gain that price difference. If the market stays below the strike, you do nothing. Your call expires worthless, and you're just out the premium you paid. A short put option, again with the strike set to the same forward price, is the flip side. By selling the put, you collect a premium up front. If the market stays above the strike, that put expires worthless, and you keep the premium. But if the market falls below the strike, the buyer of the put can sell the asset to you at that higher strike price, and you bear that loss. Here's the aha moment. If you hold a long call and simultaneously sell a put, both at the same strike that matches your forward price, you end up with a final outcome that's remarkably similar to what you get from a long forward contract. Essentially, this combination, a call option plus a short put, replicates the payoff that you'd see if you just agreed to buy the asset at that set forward price. The one major difference, options involve premiums. You pay for the call and receive money for selling the put. Depending on market conditions, those premiums may cancel each other out, or you might net pay or net receive a bit of cash. In an idealized world, imagine no bid-ask spreads, no transaction fees, and perfect market efficiency. Those premiums align so that this structure perfectly mimics the forward payoff. Choosing between a forward contract or using options comes down to flexibility. Options give you more room to play with margins and capital. Plus, understanding how they work together helps you hedge smarter by tweaking strikes to manage risk. It's a key idea in derivatives, tying everything together with concepts like put-call parity. So the next time you see someone building a position with one call and one put, both at the same strike, remember they might just be replicating a forward position with a dash of option magic thrown in. This equivalence is one of those neat tricks in finance that shows how creative people can get with derivatives to manage or speculate on prices. Keep it in your toolkit as you continue exploring the wild world of financial instruments. So, whether you're looking to go long on a forward or gain exposure through options, these positions give you multiple ways to benefit from an asset's price movement while allowing some flexibility in managing risks and returns. And there you have it, a deep dive into derivatives for CFA Level 1. From the basics of forwards, futures, swaps, and options, we've covered how these instruments work and the ways they're used to manage financial risk. Whether it's hedging against currency fluctuations, locking in commodity prices, or speculating on price movements, derivatives are central to the financial markets and play a crucial role in investment strategies. As you prepare for the CFA exam, remember the key functions and structures of each type. Understanding when and why these derivatives are used will set you up for success on the exam and beyond. Great work today, and keep up the momentum as you tackle this essential topic.